This afternoon, government borrowed 16.34 billion cedis via Treasury bills, about 6.62% increase over the month of November 2023. Is there cause for concern? We'll delve into it. Also coming up this afternoon, mobile money stands out as the predominant channel in Ghana's payment landscape, with 66% of account holders reporting weekly usage. We'll tell you more from the 2023 KPMG West Africa Banking Industry Customer Survey. Plus, we figure out how to get around our food supply challenges as Kwawu warns about potential food security problems this year.
So for those people who have not got money, food security is going to be so acute, serious in 2024.
My name is Daryl. Kwawu. Thanks for being with us. Details coming up. Well, first up, the government borrowed 16.34 billion cedis via Treasury bills, about 6.62% increase over the month of November 2023. This was to refinance matured bills worth 12.83 billion cedis. Here's more in this report.
The excess uptake was used to cover other budgetary needs. Investor demands for T-bills remained robust in December 2023 as the Treasury received bids of 16.35 billion cedis versus a combined target of 16.12 billion cedis. Yields saw mixed performance on a month-on-month basis, with a 91-day bill declining to 29.36%, while the 182-day advanced to 31.95%. The 364-day yield recorded a 74 basis points, declined to 32.46%. Analysts anticipate high auction uptakes in January 2023 to present upside pressures to T-bills yields, though continued disinflation may slow the rise. If inflation continues to decline, yields will come down.
Yields are expected to continue their steady decline, potentially getting sharper along the year as investor sentiments improve. That's according to GTB Capital. It, however, warned that election-related fiscal risks and its pass-through effects on inflation remain a risk to the outlook for the yields. Meanwhile, interbank liquidity levels have stabilized considerably, with the interbank interest rate easing to 30.11% at the week's close. Inflation is also currently on a clear path of decline and is expected to be well anchored under the current fiscal and monetary policy frameworks. Joining me on Zoom is research lead at GCB Capital, Courage Bote, to talk about this. Happy New Year to you, Courage. Talk to us a bit more about the outlook for Treasury yields. You expect a steady decline. How would that impact the markets and investor interest?
Good afternoon to you and your listeners, and Happy New Year to you as well. We've seen for the large part, I think, of Q4 that yields started trending down, and it is so because we've seen inflation back on that part of decline. We've seen, if you like, some fragile recovery in a number of macro indicators, and these are trends that, all things being equal, if we can sustain the efforts that is going on to rein in the fiscal side of things, if we can sustain the monetary tightness that we've seen so far, and even the zero deficit financing and the other reforms ongoing, should adequately prepare the market or prime the market for rate to continue to go down. Inflation as it is now will continue to go down. All things being, the only risk in here, or the most risk in here, is that we are in an election year. The support side, or what gives us confidence, is that we are in program, and so you expect the discipline mechanisms of a program to kind of anchor things. But we also know that there are high stakes in this election, and we've seen slippages in previous elections, even under program. And so depending on how government runs the show and to what extent we limit the expenditures, we may have yields continue to go down, because if all those variables behave well and the monetary stance remains tight, even if they do some cut along the way, properly tight, we should see inflation trend down. And once inflation falls below the 20% levels, I don't see why T-bill rates should stay around the 29 to 31, 32% levels that we have them now. And so the market supports that. We just have to ensure that the macros respond in the way we are seeing them and continue in that trajectory, and we do not distort it from the fiscal and monetary policy viewpoint of things.
Well, you mentioned we are under an IMF program that is supposed to help check government spending, but I mean, a recent report by Fish Solutions projects that the government would overrun anyways. How do we mitigate these risks, really? How do we go around them?
Well, it's a risk no one can completely rule out, and I can understand why. You could see the projections for the year that even in CAPEX, we've seen some significant growth in CAPEX, and it's not hard to think why. We are in an election year. Maybe there is some focus on infrastructure and other things like that. It has political capital, and it has, of course, social value as well. So it's here and there, right? But what we have seen in 2023 that worked was that revenue net did not necessarily perform. There were revenue underwhelmed to some extent, but there was that commitment to trim expenditure and normally on the discretionary items. And that is how we managed to keep the fiscals in check and even ahead of the program targets, really. Going into 2024, we haven't paid as much interest on the local bonds. In fact, we have to negotiate them down. External debt service will resume once we conclude the debt restructuring. It brings on another set of obligation. And so government would have to even be stricter on the discretionary expenditure items if revenue continue to shortfall. Now, will government be willing to do that? And in an election year where spending is a key part of the process, those we cannot say for certain. And that is why it remains on uncertainty as to how the discipline mechanisms of the program can keep us in check. And we had program in 2016 when we had overruns, really. So how the program can keep in check, and most importantly, how the authorities see the exigencies of the situation we are in and the need to, if you like, tighten our belt and get things back under control. Depending on how they see that and how committed they are to that process, we could see us sustaining the fiscal trend we are seeing now, or the overruns that a lot of other people are also alluding to.
Well, earlier we reported that government borrowed 16.34 billion cedis via Treasury bills. That's about 6.62% increase over the month of November 2023. Is there cause for concern?
That seemingly insatiable appetite for borrowing at the short end of the curve may be one of the reasons why yields will not fall as sharp as possible. Let's understand it. There are no options for investors on the market. Banks are not lending as much. Fund managers do not have options apart from the alternative assets, which in fact allocations to them are not much. Pension funds do not have options. And all of that. So it's understandable people are going into T-bills and the demand is over and above what probably the targets are. What is baffling is why the Treasury is not seizing the opportunity of such oversubscriptions to trim down yields. And the reason is this. There are also no funding sources for the government as it is now beyond T-bills and some concessional financing from the IMF, from the other, if you like, multilateral institutions and whatever you. And we've not had a lot of that coming. The IMF tranche 2 is still pending. And of course, some monies from the World Bank, the African Development Bank, still yet to, I believe, hit the account, really. So the only option available to finance the budget is do the T-bills, and they have been doing that. Remember, the second, in fact, coupon payment on the DBE bonds is coming up in February, and that is over 2 billion. The Treasury is again depending, I believe, on the T-bills market to try to raise some funds to settle that without issue. Those would have explained why there is that high appetite on that market. But if we continue in that route, taking up so much, it would limit the scope for yield to decline, even if inflation falls so low. And that is one thing government must look at. We must be strategic about it, understand the need for funds, understand the limited options, but there is also that need to balance the act so that we can sustain the decline in yields for the market once inflation recedes sufficiently.
Well, there's usually talk about how the private sector is being crowded out of the Treasury market, but then it appears the government has few options when it comes to borrowing. Is that the case? And what would be the economic impact if we continue to see this trend?
Well, there is a reason growth is below trend. Even if we are growing above the 1.5 projected for 2023, it is still below trend. And we've seen the trend from Q1, Q2 to Q3 that is declining. The investments are not going. You can see industries and contraction, and it has been so for about 3 quarters now. It means investments are not happening. Banks are averse to credit and the credit risk because of the operating environment we are in. They are going into automobiles a lot, and the Bank of Ghana governor was categorical that the deposits they mobilize are with him. They mobilized over 40 billion as at the last count in automobiles alone. Government has done so much in T-bills, over 100 billion in 2023 in T-bills issuances. And so it just tells you, and we've seen credit to the real sector contract. We've seen total advances slowing down or even contracting at some point, really. So the private sector is being crowded out, and it's reflected in the slowing growth momentum we are seeing. The sectors they play most, and banks are now playing it safe, going to areas that it's more guaranteed, or the cash turnover cycle is much shorter, and there are no risk envisaged or so much risk envisaged in those sectors. So we turn the tides. The macroeconomic recovers sufficiently. We complete this whole debt restructuring thing, and investor confidence, banks are a bit more confident. And now they are in the mode of raising capital. The last thing they want to do is raise their capital with, loans and credits to maybe the aggressive growth sectors that you cannot predict in the next 2-3 months or 6 months or a year what is going to happen, really. So you can understand why they are so cautious mode. And that is why growth will be subdued. And we need to do something about this. Government need to lessen appetite. We need to let interest rates come down to reduce the risk of default. And we need to ensure that the market is back to a balance. That is when the private sector can get credit. Until we are there, I think the subdued growth and the unemployment situation we have on our hands will linger for a while.
All right. Thank you so much, Courage Boti. Good to see you. Research lead at GCP Capital. I appreciate your time. Now, mobile money stands out as the predominant channel in Ghana's payment landscape, according to the 2023 KPMG West Africa Banking Industry Customer Survey, with 66% of respondents reporting weekly usage. Despite a substantial move towards digital channels, the country remains predominantly a cash-based economy. Here's more in this report.
The ease of transferring money between accounts and mobile wallets emerged as the most important experience metric for retail customers. Notably, certain banks refrain from imposing fees on their customers for transferring funds between their mobile money wallet and bank account, fostering convenience. Additionally, there was an uptick in customers utilizing financial technology platforms. 16% of the respondents indicated using fintech platforms weekly, up from 10% in 2022. 53% of the respondents reported using their bank's mobile app at least once a week, a 3 percentage point increase from last year. The USSD platform's penetration also continued its upward trajectory, evidenced by growth in weekly customer usage. Presently, 28% of respondents use their bank's USSD platforms weekly. Despite a substantial move towards digital channels, Ghana remains predominantly a cash-based economy. A significant 32% of respondents indicated weekly ATM usage, emphasizing the importance of 24/7 cash availability at these machines, which ranks as the second most crucial metric for retail respondents.
Well, John Appiah is Chief Executive Officer of Payment Services Provider eTransact Ghana Limited. He joins us on Zoom. Good afternoon to you. Happy New Year. What's your assessment of the progress made so far towards payments through digital channels? 16% of respondents in that KPMG survey, for instance, indicated they use fintech platforms weekly. That's up from 10% in 2022.
Daryl, thank you for having me, and Happy New Year to your viewers and your team. I think if you look at the numbers, it's on the rise. As you said, with the KPMG report, 66% of people interviewed said they use Momo at least once a week. That number is around 54% to those who use the mobile app, and around 30% of those who use USSD. And these numbers are growing. And I think, we've always said that necessity is the mother of invention, and I think there's been a necessity with what is going on around us. I think Courage touched on that with bank profitability has been an issue that we've been hearing about, everything around debt restructuring and investor confidence coupled with inflation and CD depreciation means that consumers are looking very closely at the money that they spend, and when you're looking very close at money that you spend, what the fintech or financial technology gives you is the ability to short circuit what is happening within your account to what you see on your mobile phone, for instance, So we're seeing a real progress in people taking that destiny into their own hands and following their money through a lot of our channels.
Yeah, and well, despite the uptick we saw in 2023, Ghana still remains a cash-based economy. What are the current challenges, do you think?
Daryl, I'm one of the few people, I think, who hardly carries cash around. But if you look at it, even to do with like reading of books, we still like to have the hard books, the hardback that we can touch, It requires a particular mind shift. That doesn't happen overnight. But that said, there are some challenges. We have a limited digital infrastructure in this country. We have a low financial literacy in this country. And we have a low trust. The use of money is built on that fiduciary agreement, that trust in what you're holding, and with what happens around with cybersecurity, etc., there's very low trust in the system of moving money digitally, So all those issues, I think, together are some of the main challenges that we see in being able to promote a more digitally inclined economy. But Daryl, let me just add that despite all these challenges, the most important thing is to provide value. If you can provide value to the consumer, if you save the customer time, for instance, in the past, when you're sending money to Kumasi or Takoradi or what have you, people will give money to the STC driver who then give the money when they get to their destination. But sending money digitally changed that overnight, where now I don't need to send money through someone who takes 3 or 4 hours to get to someone else. Just by the click on my phone, within 10 seconds, I can do that. What does that provide? That provides convenience. That provides speed, and the person still receives their money. So despite the challenges, there's a need for us to see how we can be more innovative with the products that we offer and how to ensure that the products that we offer actually touch a particular need of the customer.
Yeah, so how can we make the usage of fintech platforms more attractive going forward?
I think with the challenges that I discussed, the way to make it attractive is education and awareness is a very important thing. We need to really promote financial literacy so that people understand the benefits of using financial technology. And we have to ensure that we have security features encrypted within what we use, because when someone uses it once or twice and they've been defrauded, they go back to using cash because they don't trust the system. We also need to have user-friendly interfaces. When I was talking about the convenience and the speed, we need products that are very easy to use, that don't require, you're not taking another WAEC exam. We need it to be simplified, easy to use, and straight to the point. then we need to talk about affordability, because that's one issue that we saw when the e-levy was initially introduced at 1.5% and brought to 1%. We saw the increase in numbers, and affordability, especially at times of high inflation, at times of difficulty where everyone is watching their wallet, affordability is very key. Then we have to look at the type of partnerships and integrations we have between local businesses and the government. We have to work to enforce these type of partnerships. Then we need the regulatory support from the central bank. And then, like I touched on, infrastructure development is key. When you go to places where there's no signal, or you go to places where there's no POS, how do people actually transact digitally? So the infrastructure development is really key. And then we have to find ways in which we incentivize and reward consumers, through loyalty points, loyalty systems. That, I think, is the key. And lastly, security measures are the most important thing.
Okay.
You can do all these things, but if the system is not robust or secure, you have a customer who uses it once and then goes back to cash.
We have some 30 seconds to spare. How are sector players gearing up for 2024? What are the expectations?
Daryl, I'm not going to give too much of our strategy, but I think everyone is expecting 2024 to be much better than 2023. But I think, like I said, the most important thing is seeing the type of partnerships we as fintech companies can build with each other. And I really loved reading that KPMG report, because they talked of the 6 pillars, which is on integrity and trustworthiness, on great customer experience, on making sure that you manage and exceed customer expectation, and provide a system that is easy to use, and a personalized experience that allows you to build something bespoke for the customer, and understanding the customer needs. Whatever happens in 2024, these 6 pillars that KPMG wrote about in their survey, I think, are ones that all fintech companies need to adopt and see how we can use artificial intelligence and new technology to really transform the system. And the bottom line is that the consumer will be the one that benefits.
Thank you so much for your time. John Appiah is Chief Executive of eTransact Ghana Limited. Appreciate it. Now, the General Agricultural Workers Union has been raising food security concerns in this new year, urging government to put in place measures to improve food supply and tackle food inflation. Take a listen.
The food security into the 2024 is precarious in the sense that you may find food within the system. Like I'm talking about the rice that is being dumped into the market. But you see, you need to have money to be able to access that. More so, you can only eat when you have money to buy. But we are talking about a situation whereby we produce ourselves and we don't necessarily need to come out with money to buy to be able to eat. So for those people who have not got money, food security is going to be so acute, serious in 2024.
Anthony Morrison is Chief Executive of the Agribusiness Chamber Ghana, joins me on Zoom. Good afternoon to you and a Happy New Year. Anthony, how seriously should we take these food security concerns raised by Kwawu?
Thank you very much, Daryl. Can you hear me?
I can hear you.
All right. Very good afternoon and Happy New Year. I think we are in election year. Let's not discount the importance of election. And I've said on your station before that in election year, government looks at certain critical sectors of the economy. And the agriculture sector is normally neglected. For instance, they look at roads because those are the obviously conspicuous physical items that voters look at. They look at hospitals, they look at education, schools. The agriculture sector is normally not looked at in election year. And the issues of Kwawu, the concerns being raised by my brother Edward, are the same concerns, and even more on the side of the agribusiness sector, because in election year, we see a lot more importation of non-food items. And you're going to see in the coming months how the non-food items are going to contribute towards the inflation. For instance, importation of campaign materials, vehicles, and several other things, and how this is going to have negative consequences on food. But sadly, with reference to the budget that was read, you also realize that the sector has been projected to have contraction. And very also sadly to also note that certain critical sectors of the industry, poultry, vegetables, grains, if you look at the budgetary 373 pages, you realize that we have also imported over $300 million of pepper. Okay, so for me, it's a grave concern, especially if you look at the amount of money that has been allocated for the agriculture sector in this year's budget. One would look at the fact that we are working to attain certain level of food security, and for that matter, there is a need to make higher budgetary allocation. But in this year's budget, we are actually expecting less. Meanwhile, we are being told that our population is increasing, our food importation bill is increasing, and our food inflation is also quite very high, probably the highest in the sub-region or the West Africa or in Africa. So it's put in.
What can we do right now? I mean, the budget has already been read. There are still serious concerns. What can we do right now?
Well, budgets are not properties that cannot be moved. We can still go back to Parliament. The Minister for Finance can go back to Parliament with their, how do you call it, budgetary, there's a name they call it, which would push Parliament to reconsider some of the emerging issues that were not incorporated when the budget was being put together. So they call it a supplementary budget. So they can go there with a supplementary budget and raise the issues of food security, where they can seek to increase budgetary allocation for the agriculture sector. But you see, most importantly, there was $40 million that was given to the World Bank, by the World Bank to the Ministry of Food and Agriculture as a result of the VRA spillage, which has affected almost 4 regions, okay, with Volta, OT, and Eastern region.
All right, thank you, Anthony Morrison, the Chief Executive, Agribusiness Chamber. That's all the time we have for the marketplace. More news on our website, myjoyonline.com/business. My name is Daryl Kwawu. Thanks for watching.